Not flogging a dead horse with that one.
Look, we'll leave the worst performers perhaps for a little bit later in the piece, because we do have, a real focus on commodities right now, and in particular today, zinc prices. They've surged to an 11-year high this week, with falling stockpiles signaling tight supplies ahead. For some analysis on the impact of this rise, we have Mel Palancian. He's the managing director of Red River Resources, which, Mel, happens to be Australia's only listed zinc producer, and he's joining us live from Melbourne. Mel, welcome to the program. Thanks for joining us.
Thank you. Now,
Mel, I'm going to start quite basic, asking you what exactly are the main uses for zinc. And I only ask this because we talk so much about, some of these very fashionable commodities. We're talking about lithium a lot in relation to electric vehicles. We've talked about rare earths in relation to technology. So give us, paint us a picture of where zinc is actually used.
So to me, zinc is a bread and butter metal that we use in our daily lives. So nothing protects steel better than zinc. So when we look at the galvanising process for steel, we think of things like zinc aluminum as well. Nearly all cars are coated in zinc today to stop them from rusting. We also use zinc in the vulcanisation of rubber. So zinc oxide is pretty much a staple consumable to vulcanise rubber. Zinc is also heavily used in die-cast alloys from phone cradles to TV cradles, even instruments. It's a really basic metal, but also it's used for chemicals as a reagent. So even something simple as sunscreen is predominantly zinc.
Zinc.
But we're also, yeah, absolutely. It's a bread and butter metal, and it's a 14 million tonne a year market. So yeah, it's something that sort of we consume on a daily basis.
So perhaps not as sexy right now as lithium, but still important in very many ways. So then when we talk about the increase in price that we've seen as of late, hitting 10, 11-year highs, correct me if I'm wrong, but that's more of a supply side story, or is it that there is significant increasing demand for zinc being used?
I think we've seen small increases in demand year on year. So zinc demand tends to increase around about 2 to 3% year on year, which in a 14 million tonne a year market is a significant increase. But also in the last couple of years, we've seen just over 1 million tonnes of mine supply disappear through closures. And given the lack of zinc exploration in the last 20 to 30 years, there really is a shortage of quality zinc ore bodies to come to market, and I feel, given the underinvestment, there's a lot of mines that are going to take some time to come to market. So we find ourselves.
Yeah, go ahead.
We find ourselves in a situation where stockpiles have fallen from 2010 from over 1 million tonnes to today. I think the LME stockpiles are around about 175,000 tonnes and still falling.
So why was there such a disinterest in zinc exploration? Why were so many producing mines allowed to go by the wayside if zinc is such an integral commodity, and if its growth is about 3% a year, as you say?
I think in the preceding decades, so in the 50 to 60 years before around about 1990, we were basically too successful in zinc exploration, and we were too successful in modernising our mines to increase production. So.
Okay, so when it comes to Red River Resources, you talked about the demand for quality zinc. I guess I'm giving you the perfect opportunity to sort of spruik your wares, but what would set Red River's zinc apart from wherever else it comes from in the world?
So our zinc is very high grade. So our concentrate is 58, 59% zinc, which typically, concentrate grades are around about the 52%. And more importantly, we don't have any impurities. Our iron levels are very low. There's no manganese, so it's a very, very clean concentrate. And from a smelter's point of view, it smelts beautifully, and it's in very high demand.
And where does your sort of production sit right now? Are you producing large quantities? Where is the ability for you to ramp up production to really take advantage of this rise that we're seeing in prices based on a lack of supply?
Sure. So we started production in September last year, so we've been producing for 4 months now, and it's been going great. We've achieved all of our milestones that we intended to, and we're producing around about 35,000 tonnes of zinc concentrate a year. We also produce a lead concentrate and a copper concentrate as well. So we've got a mixed bag of metals that we produce out of our Thalanga mine. But really from here on, it's not just about our production story, but it's also about growth. So we can essentially double our production for zero capital in the plant, because the plant is well and truly overspec'd. So we intend to bring on our second mine, which will start next month. We'll start developing Far West, and that'll come online next year, and we'll have 2 mines feeding the one plant. But we've also got another 3 ore bodies that we intend to bring online, and also we've got 5 drill rigs spinning in the Mount Windsor Volcanics, where Thalanga's hosted. That belt hasn't seen any exploration for over 20 years, and really in our 12th exploration hole, we already found the Liontown East deposit, which is turning out to be a cracker for us. So for me, our focus is to now keep producing at Thalanga and really growing the story, growing our throughput and our output, but also growing our mine life. And I'm confident that if we keep drilling, we'll be there for decades.
Mel, it's Adam here from Shaw and Partners, and when you came to see us last year, your stock price was at 24 cents, so well done, and I didn't buy any, so bad luck to me. But secondly, I noticed that you did ship some of that copper concentrate to Glencore. Is that your major customer for that concentrate?
Yeah, so our offtake deals, the copper is with Glencore, so they take the copper at the mine gate, and the lead and zinc is contracted to Trafigura, and both of those contracts are 3-year tonnage contracts. Yeah, right. And for us, we're really grateful to have a strong partner like Glencore and Trafigura to support us.
And just sort of give us an update on your cash balance, your debt levels, because, exploration, drilling, it's all a very expensive prospect.
Sure. So our cash was $23 million at the end of December. We increased that cash position by about just over $7.5 million in the last quarter. So Thalanga is cash flow positive, and our intention is to fund our exploration and our project development work through our cash flows. So we're in a very healthy position. We've got no debt, and the company structure is a very traditional, clean structure.
Mel, thanks for coming in to speak with us today. Really appreciate it.
Thank you. Thanks for having me.
Mel Palancian, he's the MD of Red River Resources. The ticker code is RVR, and the share price is 36.5%. It was down 1.3% today. Broader market sell-off, but interesting performance considering the levels that we've seen zinc get to, must be said. Let's take a short break. We will continue to bring you analysis on this news coming in relation to the Commonwealth Bank that you can see there at the bottom of your screen. We'll also take a look at some of the big macro events, particularly in the U.S. this week. We've got Chris Wellesby from ETF Securities Australia joining us live next.